So good afternoon, everyone. Finally, after a little bit of a few snafus, we're ready to go. And thanks so much for giving me your time. And just want to start with this disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational purposes only. Educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures, forex, or stock markets, nor for any profits or loss that may be incurred. Participation in trading in these markets does involve substantial risk. It must be understood that a person can lose a substantial amount of money. Therefore, participation in these markets is not for everyone. Careful consideration of your financial position should be made prior to trading. Never risk more than 2% of your account on any trade. Do your own due diligence. And Right Line Trading is not a registered financial advisor and not a licensed commodity trading advisor. Now, with that said, I'm just going to skip through a lot of things here. And what I want to talk about first is order flow. Now, order flow is a very unique way, is a very elegant volume parameter. And what it does is it looks at the number of buyers versus the number of sellers on the dome. And what it's trying to give you is an assessment of buying pressure versus selling pressure. You know, the market is all about supply and demand. And when this number, the market delta, is 29.85, it's green and large. It tells you that there's a tremendous amount of buying pressure on the market, and it's likely that there's not enough supply to meet buying demand. Now, the way you get market delta is simply by looking at the bid-ask disparity in each price level. Now, if this is a stock, it's a cent. If it's a forex, it's a pip. If it's a future, it's a tick. Adding them all up, and you come up with a market delta value. And again, it's a very, very good metric for assessing supply and demand and looking at who's in control of the market, the bulls or the bears. Now, if it was that simple, everybody would make money trading simply this one metric. And unfortunately, the way the market is, it just isn't that simple. That's why you have to be very, very careful. If you look at stack selling, which is this red box, or stack buying, it just doesn't have the power to give you a trade entry. If you try to use individual price levels, it's just not going to be enough. Now, the major problem with looking at market delta is that sometimes this is a positive 222 and it's a down candle. Now, there's more buyers on the dome, so one would think that there's buying pressure. The problem, and this occurs only occasionally, is that the sellers are more aggressive than the buyers. If, for instance, price is at 100, the buyers will buy at 100.1, but the sellers are willing to sell at 99.7, 99.6. They're willing to take a little bit of slippage, get in a lot lower, because they're convinced that the market's going to fall. So because they're so powerful and so aggressive that even though you have more buyers on the dome, the candle is going to close to the downside. Now, that's a difficulty that you have to get past if you want to use market delta as an assessment of buy-sell pressure. And it's really important that you do so. This is much more powerful than market profile, looking at the value area high, value area low, because this is giving you an assessment of buy-sell pressure, an assessment of supply and demand on a candle by candle basis. Now, if you look at a whole series of candles, you're going to find out, you're going to see, because we've done this assessment, that one standard deviation's worth of data works. So that one bell-shaped curve's worth of data, 66 2/3% of market deltas, will tell you the direction that the candle is going to close. So on balance, a positive delta is associated with significant buying pressure and an up candle. And on balance, a negative market delta is associated with significant selling pressure and a down candle. The problem is you have to throw out the outliers. The unusual times where you get those aggressive buyers or aggressive sellers, and they turn the candle in the opposite direction to the market delta. Now, if you look at an absolute curve of the magnitude of the market delta, which is what 99.9% of indicators do, it does not tell you what's going to happen on the right edge of a chart. The reason being, the market delta can be increasing, but the sellers can be more aggressive, and therefore you can get that down candle on a positive delta. So this in no way gives you any significant information as to where price is going to close off the right edge of the chart, and that's all that matters to us. We want to know where price is going. So the way we've overcome this is really elegant and quite powerful. What we've done is we look at our order flow assessment, which is really an assessment of buying pressure and selling pressure in the market, by only looking first at the two higher time frames. We don't look at any market delta data from your trading chart. And then we only look at the two higher time frames. So let's say you're trading a 3-minute. We're looking to look at the 9-minute and the 27-minute. If you're trading a 5 range, we're going to take two fib numbers higher. We're going to look at an 8 and a 13 range. I trade Unirenko. If you're trading a 2 Unirenko, we're going to look at the 4 and the 6 Unirenko. The key is that the indicator algorithm automatically defaults to look at the two higher time frames, whether you're trading time, tick, range, whatever. And what it does is it takes those market delta values and places them into a 15-period simple moving average. Now, by taking the average delta value over 15 periods, it throws the outliers out and relies really on that one standard deviation's worth of data to create its slope. So it accurately tells you who is in control of the market, the bulls or the bears, and that is all we're interested in. So when both 15-period SMAs of those two higher time frames are sloping up, we know that bulls are firmly in control of the market. There's going to be a significant amount of buying pressure. Supply will not meet demand, and price is going to rise. When both 15-period SMAs are sloping down, then the bears are firmly in control, and again, supply will not meet demand, and price will fall. Now, when the 15-period SMAs are not in agreement and the order flow assessment is yellow, that's a great time to stand aside because the market's most likely going to chop. Now, here's some examples. Now, it's important to note a couple of things on this chart. Number one, this order flow line does not look at price on the trading chart. So price is rising because the line is green. The line is not green because price is rising. That's what makes this an independent variable. If the color of this line was dependent upon price on your trading chart, it would have no predictive value at all. Now, all we're doing right now is we're looking at the directional bias that we must trade if we're going to avoid a loser. And you can see when order flow is green, you must trade long. Believe me, I trade live every morning. And this morning I had 4 trades and 4 winners. I'm going to show those to you. You cannot, if you try to take a counter trend candle, when order flow is up, you're going to get stopped out. Now here you have a small pullback with order flow, but I'm going to show you a few other rules as to why you cannot take this. You're just going to trade long. Now, I can go into a long thesis as to why I don't counter trend trade. And I constantly see software and mentors trying to teach you how to call tops and bottoms. And I strongly recommend that you don't. You trade with the trend, you trade in the direction of institutional money. But if you really, really feel compelled to trade a top or a bottom, you have to wait for order flow to turn. Even then, like here, it's extremely risky. Here's another example. Now, this is, I think, something that's very important, and you're going to see how I utilized it this morning in trading. We made like 35 NASDAQ points this morning. When order flow is green and you must trade long, these counter trend traders are setting us up for a better trade. We're going to let them take the pullback, which we know has a very, very, it's very risky. It's likely to fail. And what we're going to do is we're going to take the first up candle in the direction of order flow. So that price is going to be driven up by 2 forces. Not only the addition of more buyers, but we're going to be stopping out all the traders in this counter trend move. This always helps us. You get a retracement, you go long, because you're going to stop out all these sellers caught in the counter trend direction. Now, why are they trading in a counter trend direction against order flow? Well, they're trading MACD divergence, they're trading oscillator divergence, Gann theory, Elliott wave, maybe even Fibonacci resistance. All of that is not going to work. The only thing that creates this kind of buying pressure in the market is institutional money. And as long as institutional money is creating this kind of buying pressure in the market, you cannot counter trend trade against that direction. And here's just one more example. You can see that order flow is green. You've got to trade long. It's almost a directional mandate. If you're having trouble making money, we're up almost $5,000 this month, and I'm going to show you our performance. You have to trade in the direction of buying pressure when it's reflected in order flow. And all order flow is doing is showing you that all of this buying pressure must be created by institutional money. Look at this lone down candle. Who's trading that short? Well, it's certainly not you. It's certainly not me, and it should never be you. We're going to go long and run them over. Here, yellow, we don't trade. Here's our direction short, and here's our direction long. Now, what's really good about order flow as well, in the way that we've created the assessment, is that it really accurately reflects chop. Now, with one line, it's impossible to tell whether this is going to stay red or go green or go red and green. But that's always the case when you're looking at one force that is responsible for the movement of price off the right edge of the chart. The important thing to note, though, right now is that when order flow doesn't have a specific direction, price is going to chop. And once institutional money comes in and creates all this buying pressure, and now there is not enough supply to meet the buying demand, up goes price. Now, I always ask traders in my trading room, and I always bring this up in a webinar because it's so important, and that is, what is the most important mandate we have when we trade? And almost everyone will say it's to get winners, but that is not correct. The most important mandate that we have as traders, either swing traders or day traders, is to avoid losers. If you can avoid the losers, you can make an astronomically high amount of money. And this is the system that we have allows us to do that. We're only going to trade in markets that reflect significant consistent buying pressure or significant consistent selling pressure, and that can only be created when institutional or bank money, when big money is brought to bear on the market. Now I'm going to go to a different deck. I'm going to drop this. These are the charts. I'm going to show you some of these charts later. And bring up a different deck right here. Now, what I want to talk about now is something that's very, very misunderstood, misused, misinterpreted, and that is how you trade stochastic, what stochastic means, and really what's the best way to leverage it so that it really does increase your win percentage. Because after all, that's the only thing that matters, is trading with an incredible amount of precision. You also need patience. You also have to really adhere to the rules, but you also need the right trading methodology. So let me talk to you a little bit about the oscillator. Now, the oscillator was created by George Lane back in 1957, and this was a very, very brilliant guy who believed that divergence signals drove the market, and he created the stochastic oscillator. I believe it was the second indicator to ever be created. The first, I believe, was MACD, and in '57, way back when the charting was very primitive, he created the stochastic oscillator, and he based it on this. He based it on the assessment of momentum, and that's what an oscillator is looking at. It is looking at the acceleration of price to its height or its apogee, or the acceleration of price to its perigee or to its lowest point. If price is moving up at a constant speed, momentum is constant and the oscillator will be flat. You need price acceleration either up or to the downside in order for momentum to go up. Now, momentum is a second order metric. The first order metric is speed. And if you liken it to a car going around a racetrack, speed is simply going around at 150 miles an hour. That's speed. That's first order. The second order is the rate of change of speed, or acceleration or deceleration. So if that race car starts to accelerate from 150 to 160, 70, 80, 90, 200, it now is gathering momentum. Now, he believed that because momentum was a second order derivation, it would lead price. So it would foreshadow reversals. And it would do so on bullish or bearish divergences. And that's how he used the indicator. Now, back in 1957, I believe that that was probably a very accurate way to trade, because I'm going to talk a little bit about what's happened in the market recently. I'm going to give you a set of my rules that I think you should live by, because they're making us, we're very successful with these rules, based upon the changes that have taken place since George Lane developed his strategy. Now, just a really quick on the formula for stochastic. You understand it, and it's real simple. It'll give you a better handle on what you're looking at. And remember that relative strength, Williams percent K, ADR, ADX are all variations of this formula. And there are really only three key things you have to know. Is that C is the most recent closing price. Then the formula creates a 14-period moving average of the lows. So it looks back at the previous 14 lows and creates a moving average. And it looks at the previous 14 highs and creates a moving average. And when price closes closer and closer to that average high, you're getting acceleration of price to the upside. When price is approaching that average low, getting closer and closer and closer, so the close is getting closer to the low of the move, or the close is getting closer and closer to the high of the move, momentum is moving to the upside or the downside, and the oscillator, that percent K line, is going to move up. So the percent K line is simply the acceleration of price to the upside as the close of the candle approaches the high, or the close of the candle approaches the low. And if you want to use that percent K crossover of the percent D is just a 3-period moving average of percent K. The percent K line is the only thing that's important. Now, this is an old slide to show how divergence most likely worked back in the day. Now, I know some traders still trade it, but I'm telling you, it works sometimes and doesn't work others. And when you can't figure out when it's going to work and when it's not going to work, or make an assessment of risk on a trade, then the signal should not be used, because it's going to walk you into losers. So price accelerates up to this high, and it creates this much momentum. It then retraces, but when it accelerates up to the same high, it does so with less momentum. It doesn't accelerate to this high quite so fast. So this divergence in momentum is what precedes a price collapse. Now, in this particular case, and the reason I showed it is because price tried to make a third high, never quite got up to the first two highs, but it tried to accelerate up. It did so on equal momentum to the previous move up, and then price collapsed. So when price doesn't accelerate up to a high with as much momentum as it does, and it makes another equal high, George Lane felt that that was going to foreshadow a collapse in price, momentum divergence. Now, I just wanted to show you a different kind of divergence, and that's where price accelerates to this high with this much divergence. I'm sorry, with this much momentum, then retraces and accelerates higher, but with equal momentum. Now, if it accelerates to a higher price, it should accelerate up to that price with more momentum. This move should push price at a faster pace. It doesn't, and you get a collapse in price. Now, back in the day of George Lane, the oscillator was also good for buying and selling overbought, oversold signals. When the %K line crossed the 80 line to the downside, you shorted it because the market was overbought, and that overbought the overbought situation was relieved when that line crossed the 80 line, and you got a short signal. When the %K line crossed the 20 line, you got a long signal. When it crossed the 20 line again, you got a long signal. Crossed the 20 line, down across the 80 line. This didn't go anywhere, but this gave you a huge short here, and this coming up above the 20 line gave you a huge long. Now something's changed in the market, because here's what happens now, and that is, and again, I just pulled the slide off the internet. This is China Lending Corp. It could be anything. The point that I wanted to make was that overbought no longer means overbought. That we both know that any stock, any financial instrument can move to overbought and stay overbought, not just for hours, but for days or weeks. And it will run over multiple divergence signals. Like today at the open, and I'll show you, the NASDAQ just broke to the upside, and it kept moving higher and higher and higher and higher. And even though it looked like it was significantly extended on the move, as long as institutional money continues to drive price higher, it does not care one bit what this oscillator is telling you. I mean, each oscillator has different inputs, there's different time frames. If institutional money, if bank money, believes that the instrument is oversold and they want to continue to drive price higher, they will do it. And you know, as we all know, they can do it for hours, days, weeks, and months. And divergent signals are just going to be a complete shambles. Now, here's the difference in the market today versus what was present in the market before. When in the market of George Lane, essentially the power of every buyer was equal to the power of every seller. I mean, institutional money and or bank money only made up a very tiny percentage of the overall volume. Market was moved essentially by commercial traders, the small guys like us. Volume was a lot less. And when the power of every buyer equaled the power of every seller, divergent signals had a lot more validity, and the market didn't stay overbought for weeks or months. Now, with institutional money becoming a bigger and bigger factor in the way we trade, we cannot take divergent signals anymore. Now, this has also skewed a lot of other things that we have to think about. If institutional money is going to drive a price higher and keep it overbought for days, weeks, or months, there is no mathematical formula that's going to call a high or going to call a low. It is mathematically impossible, I promise you. And if you see anyone telling you otherwise, I'm telling you they're wrong. And very rarely am I dogmatic. There's a lot of right ways to do things, and there's a lot of wrong ways to do things. But calling a top and calling a bottom, you can do it sometimes and you can't do it other times. And if that's the case, you can't do it, because you have to be able to assess risk on the move. What it's also done has really weakened the power of Japanese candlestick formations. They're also predicated on the fact that the power of every buyer is equal to the power of every seller. And I love Japanese candlestick formations, and I watch them and I like them, but they just don't have the throw weight anymore. Because when institutional money steps in, it doesn't make any difference. Now institutional money has completely destroyed Elliott wave and Gann theory. Because Elliott wave and Gann theory hypothesize that there's an intrinsic waveform within a market, which is a closed system. And that waveform is present only, though, when the power of every buyer is equal to the power of every seller. I personally believe it's also destroyed Fibonacci, but I'm not going to be dogmatic about that. But the bottom line is that institutional money rules. And if you're going to try to trade Japanese candlestick formations alone, and I see that being proffered all the time, you're going to get beaten up. Try to call a top or a bottom, you're going to get beaten up. And this is really how you have to trade. There's no such thing as an overbought or oversold signal. That's just a fallacy. Markets reverse only at the whim of institutional money. Now, there's still going to be reversion to the mean, and that's always is going to apply. When institutional money, now the further off the mean price that institutional money drives price, the quicker it'll snap back. I mean, if it's 3 standard deviations off of your 50-period moving average, when institutional money steps aside, it'll snap back faster. And that's what a lot of these counter trend traders are looking for. They're looking for that snap back to the mean and that really, really large, successful move. But it's impossible to determine when it's going to occur. So that's the problem. And trading divergence is tantamount to trading against the flow of institutional money. You can only trade in the direction of money flow. Now, the only oscillator that does not look for divergence, but assesses buying and selling pressure is the Ligia Oscillator. It's a much more complex formula. It has a default gamma set to 0.5, which we've modified. It has multiple smoothing filters to ultimately create the %K that you want. We have it set to be rapid and stable. And here's what we want it to do. Now, we always do every assessment that we make on a multi-time frame basis. Order flow is done on a multi-time frame basis. Our Laguerre, as an assessment of momentum, is done on a multi-time frame basis. Now, what is the Laguerre tracking? If the Laguerre, this is the multi-time frame line, this upper line, if it goes to overbought and locks overbought, it's telling you that there's tremendous buying pressure on the market. And only institutional money can do this. So what we look for is an alignment of multi-time frame momentum. Not just an alignment, but a locked alignment, either to the long side or the short side. Now look what happens when the multi-time frame has no direction. Price just chops. But as soon as it goes green, price is going to rise. That's a 3-minute. Now you want the Laguerre on your trading chart to move into the direction of the long term. And that's signaled by the arrow that you're going to get on your chart intra-candle. And it's telling you that the Laguerre on your trading chart has now crossed above the 20 line and is heading up long into the direction of the multi-time frame Laguerre. And you're going to take the entry right here and you're going to hold it long until you get this arrow. This arrow is when your trading chart Laguerre drops below the 80 line. All we're doing here is using momentum as a proxy for institutional money. Now, you'll notice we are not looking for divergence. The Laguerre doesn't look for divergence. And I just don't want to run over. I don't want to have time for questions. You see it's locked long here. Price is going to rise. The entry is right here on the arrow. Intra-candle, you get it, you go long. The Laguerre on your trading chart is just crossed up, and you have to trade to the long side because that's the direction of institutional money. When you add order flow to this on a multi-time frame basis, you've got an entry and an absolute direction. Here's a short trade. You go short on the retracement, the counter trend trades, you just continue short. These are both Laguerres locked short. Only institutional money can plaster these Laguerres to the zero line. And that's exactly what's taking place here. These are plastered down against the zero line. Again here. Again here. You move up, retracement. Both Laguerres are plastered to the 100 line, and up you go. Now, I can go on and give you, this is a 60-minute, give you tons of examples. Here's a 3-minute. I just want to just show you quickly the difference between the Laguerre, stochastic, and relative strength. Here's the cross of the chart Laguerre across the 80, the arrow, locked short on a multi-time frame basis all the way. There's your entry. And you stay short till this arrow gives you a long signal. But look what happens to stochastic. It comes above the 20 line because it's not meant to track buying pressure or selling pressure. It's made to look for divergence, and it takes you out of the trade. Relative strength, RSI, doesn't give you an entry at all. And I just want to make this one statement, which I believe to be very true. No indicator that assesses data from your trading chart alone is going to able to project out into the future where price is going to move. You must assess data from the higher time frames. That's why all of our data is done on a multi-time frame basis. I'm going to go through these. Now this is the offer, but I'll come back to it. It's $6.99, free upgrades for life. You get 1 month in the live trading room with me. This month we're going to eclipse, I think, $6,000 in the room. You get a 10 module educational training, video tutorial library. And now the first 10 get the pivot indicator, which I haven't even talked about, but I want to show you a live chart before I do anything. So hang on 1 second, and let me bring that up for you, because I can show you anything off of slides, but what I want to do is show you the system on a live chart. Now, before I even do this, I want to show you our performance here. Now, this is NinjaTrader. This is my back end. We do this every day. Here's the account performance. Today, we're looking to make 1,000 a week. Today we had 4 trades. We made 100, 180, and 100. Our summary for the day was $380. We were done in 45 minutes. We go back to the beginning of the month, when I started trading, we're up $4,930. I'm trading at 83.52% accuracy. You can't do that unless you have a system that's gives you incredible precision. Now, by the time the week is over, we will eclipse 5,000 and pay for commissions, and you'll clear $5,000 for the week, for the month. So that's the system that we're looking at. Now, I didn't talk to you about pivots, and I don't have time. But when you break a pivot right here, remember, you're running over, the pivot has all short traders in it. And I just don't have time to explain it, but this is a terrific long trade right here. Here, I'm going to remove the order flow line because order flow is projected on the candle halo. The candle halo is blue. Order flow is in your direction to the upside. And you can make that whatever color you want. Candle halo is magenta. Then order flow is projected to the downside. And that's a default color that you can decide on. So now we're simply looking. Here's our long-term Laguerre. Here's our chart Laguerre. We get a pullback. You can see the candles outlined. Order flows to the upside. That's a terrific chart right here on the NQ. Oh, that's uncrude. And here's, well, we don't have the multi-tool. Here's your pullback and your continuation trade. Now we only go long when we're above the 50 and the 15's above the 50. We only go short when we're below the 50 and the 15's below the 50. And I can tell you, you get very, very few losing signals. Very rarely are you going to get a loser. Right here, it's another continuation trade to the upside. Now let me just put up the, I'm sorry I don't have more time. I get to take a couple of minutes because we didn't quite start on time. Let me put up the offer again, and then I'll answer any questions that you have. I wish I had more time to show you more instruments because I just showed you futures. Now I want to make it clear. This is time frame independent and it's instrument independent. It doesn't matter whether you're trading stocks, futures, or Forex. These forces are universal forces. You can trade a 3-minute, a 1-hour bar, a 4-hour bar, a daily bar. It doesn't matter. You can trade a stock, a future, or a Forex. It doesn't matter. Order flow is universally, is a universal price that determines buying pressure and selling pressure. It's irrelevant of instrument. Momentum as well, irrelevant of instrument and time frame. So at 699, the first 10 get the pivot indicator, which is, I didn't have time to go into the merits of it, but our pivot indicator is very different. And the first 10 get 2 months in the live trading room instead of 1. If you're in the live trading room this month, it'd be up well over $5,000. Now the offer expires on Friday. Let me just answer a few quick questions and then I'm going to leave. I don't want to overstay. And let me find the questions here. Audience questions. Hang on one second here. Here's my chat. Okay. I'm not sure I have any questions. Let me just make sure. Nope. Okay, well, listen, thank you so much for giving me your time. If you have any questions, you feel free to call us at 786-732-4656. And I really appreciate you giving me the time and allowing me to participate in the Traders Talk event. Thanks again. And listen, I wish you the best of luck and have a really, really wonderful day. Take care all. Bye-bye.